The Reserve Bank's rate hike was as expected. The stunner was RBI's determination to chase down inflation. First, sample these two statements from the governor and his deputy governor.
India's GDP growth is resilient. It is holding on and it is doing well in a world of slowing growth and possibilities of recession across several countries.
The worst of inflation is over, but the moderation of inflation will be very grudging, very uneven. So we must shepherd inflation first firmly into the tolerance band and then to the target.
Put the statements together. What are the two telling us? The RBI is using the cushion of decent growth to do some hard work on inflation, which it believes is not going down very soon. Bond yields shot up as the market priced in another hike in February. But is that the way to read the policy? Is this the best recipe for the economy itself? Was the rupee weakness an unstated reason for the hawkishness? And how will macros shape up in 2023? For all this, I'm joined by the best doctors of the economy. I have with me Mr. Dinesh Khara, the chairman of State Bank of India, Mridul Saggar, former member of the MPC and now professor at IIM Kozhikode, Samiran Chakraborty, chief economist, Citi, and B. Prasanna, head global markets group at ICICI Bank, perhaps India's best bond market expert. Thank you, gentlemen, for joining me. Mr. Khara will be with us in a moment, but let me start with the man who has been there, done that, Mridul. How would you read this policy, Mridul? The big takeaway for you?
So, I put it that this policy was priced with destiny, really. I mean, where policymaker views and markets views converged, the quantum of the rate hike was very much there. As you put it, what you called a stunner, yes, that was the only surprise to my mind, that the communication, which the markets were expecting it to be the softer in terms of stance, and I'm so happy that the RBI actually eschewed falling into that trap. Like the guidance that the rate hikes are at the end of its cycle would have been rather bad at this stage because there are three clear reasons which the RBI stated on it. One, the sticky core inflation. One, anchoring inflation expectations was important. And third was controlling the second round effect. I'll add a fourth reason to that the negative deposit rates in real terms are still negative. At the end of the October, the weighted average term deposit rate in real terms had a negative carry of 1.28% as per the RBI data, because 5.49% was the rate weighted for across, and 6.77% was the inflation, which means a negative carry of 1.28%. So it's true that inflation will soften and this negative real rates may roundabout get over in coming months, but it needs to be pushed a little bit forward. So clearly the rate cycle end, not calling a rate cycle end was a right policy decision, and I think markets would adjust to it. But obviously, it will sort of reach a stage where central banks' pivots will come during 2023 at various point of time, depending on the forward-looking data.
Okay. You said this policy made you happy. That makes two of us, Mridul, because I would think that the Reserve Bank has been extremely prescient and outstanding in the way it has clearly enunciated that its goal is to bring inflation to target. And target is not under 6, target is 4. Samiran Chakraborty, what hereafter would you read? When the governor says that, removal of accommodation is not over, should we only assume February hike or should we assume even more?
Hi, Lata. I think the key point for us was that the emphasis on the stickiness of core inflation.
Oh, yes.
We all understand that this is not a stated objective of the MPC framework, but to bring core inflation into the operative part of the MPC's forward guidance now makes us look at that number much more seriously. So whether RBI will just be comfortable with a slowdown in the momentum of core inflation or would actually want core inflation to also come down to a significantly lower level, maybe closer to 4%, is something that we need to see. Why this is important is that a inflation basket which has such a high proportion of volatile food and fuel items, if core inflation is not closer to the target, there is always a risk that we will reach that 6% upper limit with even small shocks. So that's where I think this policy is very important, that it is bringing in that core inflation and using a strong phrase like breaking the core inflation persistence. And we are bringing in the possibility of another 25 basis point hike over the 6.5% terminal rate that we already had in our forecast. But making that our baseline view becomes a bit difficult because the timeline for that is April 2023, which is still far way off, and a lot of things can change by then. But if core inflation momentum does not recede by April 2023, then we will not be surprised if the RBI goes one notch higher to 6.75 from the current baseline view that we have of 6.5.
What's your forecast now on core inflation? I mean, I have never collected that from you separately, but is it receding from 6 by April in your estimate?
It is coming off because what we typically would try to model core inflation on the back of output gap. And the output gap is going to close down by end of this fiscal year. But then next year, since we are baking in the lagged impact of monetary tightening and the global recession, the output gap might become slightly negative again. And in that context, the core inflation momentum should also slow down. But it looks like even for next year, the average core inflation could be between 5 to 5.5% and not closer to 4% unless there's significant global commodity price corrections.
Okay, fair enough. Okay, now for the man who has to make money for others and for his bank, Prasanna. Prasanna, what were your takeaways? And now where do you see the 10-year, the OIS, etc. Ranging? Do you see more yield jumps?
So I think, Lata, first thing, I think what the policy did is to signal to the market participants, all the stakeholders, that stop looking at just the US rates to decide on where the RBI policy is going to be and start looking at Indian inflation very closely. I think that to me is a very, very important statement, because somewhere in the last 2 years post-COVID, our focus on the 4% inflation target, for all the right reasons, kind of got diluted, and we were okay with the 2 to 6% kind of a range. And we were also sometimes okay with the fact that due to the health reasons and due to the fact that it is a really big scare, we were even okay with a inflation of higher than 6%. And like I said, for all the right reasons. But I think right now, since economy is reasonably doing much better than most of the other economies, I think it's the right time for RBI to get the focus back on what we call as a 4% inflation target and not just the 2 to 6%. And that, I think, is what this policy has done, number one. And number two, what it has done, like I said, is also to bring the focus back, like Samiran said, on how the inflation trajectory is going to go, how the core inflation, more importantly, is going to move. So from that perspective, I think a lot of expectations which were built in prior to the policy that the Fed is going to slow down, Fed's pivot has almost happened, so RBI's pivot will happen, so it's a dovish hike that we are going to expect. All those expectations have got belied. And I think now he's basically put us all on tenterhooks again to look at where going forward our inflation is and growth. That's basically where the growth inflation dynamic is. So from that perspective, I think I would kind of agree exactly with what Samiran said, which is to say that the next 25 basis points is kind of a certainty in February. But by the time the policy after that, so which means we'll go to 6.5. And by the time the next policy happens in April, in all probability, the Fed would have probably pivoted and would have probably paused or looking to pause. So that is the only uncertainty uncertainty that I can see. But otherwise, if you look at the inflation trajectory and the fact about real rates that Dr. Patra spoke about, it's pretty clear that they have to keep rates at a higher level and maybe go to something like 675 or so. So from that perspective, I think a lot of repricing is happening in the market, but at the same time, a lot of other things are also happening in the global markets. Like you would see that the US bond yields are now unable to go beyond 360. They are again coming back towards the 350 mark on the 10-year at least, even though the 2-year is pretty much on the higher side. And even though you have a Fed futures expectation of a 5% Fed rate, and you've also seen the crude oil prices, coming down, in fact, crashing, I should say. So these things are the opposing effects which are kind of ameliorating each other. Okay. And hence, I think the repricing is constantly happening. I would say that for the month of December and maybe till the budget, we don't see 750 also. I would say 740 as the kind of peak, 720 to 740 as a range. But then when the budget comes, the budget arithmetic will then determine how bond yields move beyond that.
Okay, very quickly then, Prasanna, do you think it's very clear now deposit rates, at least in some big banks, will have to start moving up? I will get Mr. Khara sooner or later to speak about that. But do you think the amount of money that was going into the stock markets or into risk assets in general may start decreasing as interest rates start becoming attractive, as debt starts becoming attractive?
Yeah, so Lata, I think there are two different arguments. One is if you're looking at an incremental investment options for an investor at an 8%, let's say 8% fixed deposit rate. No, most of the banks are still not at 8, but I'm just giving it as an example. If you talk about an 8% fixed deposit rate or a debt return of 8% coming from a mutual fund, definitely is a serious threat for the kind of returns that you can potentially make in a risky instrument like equities. And that itself by itself calls for an asset allocation which shifts from equities towards debt. So that is one part of the argument. Yes, on an incremental basis, yes, it makes the case weaker for equities and makes the case stronger for fixed income as deposit rates keep increasing. But on the other hand, a lot of discussions have also happened, Lata, in the media and various other places about the small savings mobilizations and equity market mobilizations actually impacting banks' liability growth. But I think what I would say here is that technically it's only the CASA which the banks get should not be impacted at all by this, because ultimately this money, even though it goes to small savings, it comes back to the system when the government spends, or when it goes into equity mobilizations, that also comes back to the banking system in the form of current account deposits. So yes, while term deposits of the banking system is getting impacted because possibly getting impacted that too because of the equity mobilization, the overall banking system deposits can only can only go down if either a current account deficit happens or if the CIC increases.
No, very short, very quick answer. Do you think that the money going into stock markets could recede a bit? Yes or no?
Yeah, I thought I did answer that.
Yeah, that's right. Okay, you think debt becomes...
it makes the case weaker.
But debt becomes attractive.
Yeah, incrementally debt is becoming on the margin more attractive than equity as the deposit rates increase.
Okay, I'll run for a mandatory break. Back with much more, especially on the